Hard to put a glass on a slope here, so I'm not gonna try that. Thank you very much. It's great to be here with all you folks. Lots to talk about. I always feel younger when I come to these things. And maybe it's because of that picture that's about 20 years old. But I haven't really changed that much. I don't think so. But you can tell me that yourself later. Look, they gave me 20 minutes to discuss comparing the current decade to the 3 previous decades, so I got to get going. And what I want to do is discuss 3 scenarios that I think can be put in the context of the history of the 1920s, and then the 1990s, and then back to the 1970s. So 2 of the scenarios are pretty good. The first one, the 1920s, was great, but it ended badly. I know that. But that is our base case scenario, that this is very reminiscent of the 1920s environment, and that we're likely to see technology leading the way in increasing productivity. Speaking of technology, let me see if I can press this button and something will happen. That's pretty good. So in the 1920s, the 1920s started out awful. They started out with of course, before the 1920s, there was a world war. They called it the Great War because we didn't have World War II at the time, obviously. And then when peace came, a lot of the soldiers picked up all sorts of diseases in the trenches, and when they came back home, we had the spread around the world of the Spanish flu. So that's certainly a similarity between what happened back then and the pandemic that we experienced here. Then there was a recession. They called it the Depression back then because macroeconomists hadn't come around to invent the word recession, so they called it a depression. And that was 1920, 1921. And then if you were thinking about the outlook for the rest of the 1920s, it had to be extremely depressing given what had just been going on over the past few years. And instead it turned out to be the roaring 2020s because we had peace, we had globalization, we had more trade, but most importantly, we had a tremendous surge in technological innovations, auto, natural gas going to houses, electricity, roads, lots of technologies that dramatically increased productivity. And productivity really is the fairy dust of an economy. If you've got productivity growing at a better rate, you get better real GDP growth, you get lower inflation. Consumers actually see that their workers see that their wages rise faster than prices, real wages go up, so you get an increase in the purchasing power of the consumers to buy the cars, to buy appliances and so on. And then you also get an increase in the profit margin. So the only thing that could possibly go wrong with productivity is that it might cause some people to lose jobs, which is obviously not a happy circumstance. But history shows that on balance, other jobs are created, and you actually continue to have an environment where the economy is growing, booming, and you have pretty much full employment. So I think there are similarities between that and the roaring 2020s. We started talking about the roaring 2020s in 2019, and we said, well, there's a confluence of technologies, robotics, automation, AI. We didn't know that AI was going to come on strong the way it did starting in late 2022, but here it is, and that certainly adds to it. I think what we're seeing here is a continuation of the digital revolution. The digital revolution started in the 1950s, and during that digital revolution, it started out with the IBM mainframes. For those of you who remember back then, I remember back then, I did a PhD dissertation where I had to go to my university's computer center. They had a mainframe, and I had to bring like a stack of IBM cards that I had pre-punched with the program that I wanted them to run. And they ran it, and then the next day I would pick up the output on a big stack of paper that was printed out. So it was very cumbersome, but that was state of the art back then. Along the way, we had mini computers, we had PCs, we had laptops, We've had the cloud. We've had now AI. And so I kind of view AI not as a revolutionary development. I view it as an evolutionary development in the digital revolution. And what is the digital revolution all about? It's really very simple. All we're trying to do is process as much data, more and more data as we possibly can, as quickly as possible, as cheaply as possible. And now we've gotten to the point where we can do that to such an extent with AI that we had to basically design large language models to help us interpret what we can now do with all this technology. I think the AI models that are open to the internet and this kind of suck in all the information that's available on the internet, that's kind of garbage in, garbage out. There's a lot of garbage on the internet. They'll come to conclusions based on that, and then they'll spit it out, and a lot of that garbage will go right back into the internet. So I think that's something to consider. But other AIs, where the AI just processes data that are, is good data, it's internal to your company, or you purchased it from somebody else and that's been vetted. AI can really process a tremendous amount of data very quickly and is very useful in coming up with conclusions. At first, everybody kind of laughed at it because you'd ask ChatGPT a question, or there were some setups where you could have a conversation and it started to have hallucinations. I think one of these conversations, the AI model declared love for the person who asked the question. It was kind of bizarre. But I think we're making a lot of progress, especially not with open AI, as I would call it, but closed AI. So I'm a big believer that's a big positive. So the U.S. economy, meanwhile, continues to do extremely well. Part of it is AI. The other part of it is American consumers. You never, ever want to bet against U.S. consumers. When we are happy, we spend money. When we're depressed, we spend even more money if we can find it. If we still have a job, if we still have some balances on our credit cards. But a lot of economists over the past 3 years thought, well, look, the Fed just raised interest rates, mortgage rates have soared, consumer credit, auto loan rates have soared. Surely we're going to have a recession. And we were arguing, well, not necessarily so. We could have rolling recessions hitting different industries at different times. Housing was in a recession, but you have to be careful because multifamily was actually doing pretty well for a while. Now it's not doing quite as well. We had a recession, kind of a slowdown, a growth recession in manufacturing since 2022, late 2022. And part of that wasn't because the Fed tightened. Part of that was because we went on a buying binge. We went shopping after the pandemic. Again, one of the best ways to overcome cabin fever is to go shopping. It releases dopamine, makes us feel good. And so we all went and did that. We couldn't buy services because they were still restricted. There were still distancing requirements. So we bought goods. And so we had this big, huge binge in buying goods. And then we stopped. The surprising thing is when you look at the chart, the goods didn't suddenly take a dive. They just kind of went sideways. The demand for goods just went sideways while the demand for services went up. And if you looked at the demand for services and kind of say, well, what's driving that up after they already binged on goods? So there were some questions of whether they could continue to do that. Smart guys like, smart people like Jamie Dimon said, I think it was in 2022, there's a hurricane coming. The consumers piled up a lot of excess savings during the pandemic. They couldn't spend during 2 months of the pandemic, so they saved some money there. And then the government kept throwing checks at us three times in a row. And it looked like we were talking about something like $2 trillion in excess savings. And the thesis was that the only thing keeping the economy going was that people were spending this excess savings. And I argued that's maybe true to some extent. But I'm a baby boomer, and that gave me a little bit of inside information because I have a lot of friends who are baby boomers. I'm still working for a living. I have 5 kids. The youngest just got out of college a few years ago, so I was paying college tuition. I don't remember being in pain for the first 3 on college tuition, but the last 2, it was very, very expensive. But anyways, I don't have that now. I've paid off my mortgage, but I'm still working for a living because I really enjoy what I'm doing. But my friends who might have had 2 kids instead of 5 kids, the kids are older, they should be relatively independent. They paid off their mortgages. They have piled a tremendous amount of assets. They don't have a student to pay for your colleges anymore. And so if you look at this chart here that I'm showing you, it shows that the household sector has something like $160 trillion, not billions, $160 trillion in net worth. And the baby boomers have half of that, about $80 trillion. It's really quite extraordinary. There's never been a generation this wealthy. A good part of our income inequality and wealth inequality has to do with the demography of aging. The baby boomers listen to not Dr. Spock, but Spock from Star Trek. And Spock from Star Trek told us, live long and prosper. And it looks like a lot of us are doing that. And by living long, you give yourself more time for your assets to compound. Real estate has been doing that. Stock market's been doing that. If you've been reinvesting in your fixed income portfolios, they've been doing that. So the baby boomers are extremely wealthy. And I think clearly there's plenty that aren't. There's plenty that are ultra wealthy. But when you put it all together, we're talking about a tremendous amount of money. And it does seem to be having an impact. My friends are going on cruises a lot. They are going to climb Mount Machu Picchu in Peru. But before they do that, they want to go see the doctor and ask the doctor, Doc, can I make it up the mountain? So tremendous amount of spending on healthcare, employment all-time record high in that sector, tremendous amount of spending on hospitality and leisure. If it's just the 2 of you, what's the point of cooking anymore? So people go out now for breakfast, lunch, and dinner. And so we've seen tremendous demand in that area. So we were arguing that the consumer, which is clearly the key component of economic growth, will continue to spend, and that's what happened. Meanwhile, on the capital spending side, companies have been spending more and more on technology. This chart shows that currently companies are spending about 50% of their current dollar capital spending on technology. And this is got to be an understatement. I think the ratio's going to be more, because this just includes R&D, includes software, includes technology hardware. It doesn't include like industrial machinery, and industrial machinery what is that? It's high-tech hardware with high-tech software. Trucks are sort of high-tech. They're kind of like the device that's run by a software logistics program. And so you can see there's been tremendous increase in the percent of capital spending that's going into technology. And I think it's having an impact on productivity. And I think we've never had so many technological tools that have the potential to augment the brain. In the past, technology innovations augmented brawn, strength, the ability to manufacture down an assembly line quickly, the ability to, instead of having to dig ditches, you have machines that do that. So we had the agricultural revolution a few centuries ago, followed by the industrial revolution, and now we've got the digital revolution. And the digital revolution, I think, is already starting to show signs of boosting productivity. And so this is the five-year average growth rate and productivity. And you can see we had a productivity boom in the late 50s. We had a productivity boom in the 60s. Another mini productivity boom after Reagan was elected. Then a productivity boom in the 90s. And then that kind of fizzled away, and now I think we're in a productivity boom that has a lot more going for it, as I said, and I think productivity could grow 3.5% to 4.5%, which means that economic growth will be better than expected. It should keep inflation down because productivity is a key driver of unit labor costs, which is what determines inflation in the labor market. So In the roaring 2020s, let me surprise myself and see what other chart I put in here. In the roaring 2020s, what is the outlook for earnings and what's the outlook for the stock market? Well, we've been at the top of the list in terms of predicting earnings for the past 3 years because we didn't expect a recession, so we had higher earnings than most. We didn't have to change them over the past 3 years. It stayed remarkably consistent with reality. And now, we got $285 a share for the S&P 500 for this year, $320 a share for the S&P 500 next year, and $400 by 2029. And that's based on a fairly conventional view that revenues will grow 4 to 5% in current dollars. But it's also based on the view that productivity will boost profit margins. And so that's where we get better than expected earnings. And if that's the case, we think that the bull market, which clearly is stretched on a valuation basis, can very well continue on an earnings basis. And on that basis, we think we can get the market up to 7,000 by the end of the year, 8,000 by the end of next year, and the S&P 500 to 10,000 by 2029. We're clearly assuming there's not going to be any terrible recession along the way. I think a lot of economists that were wrong about the past 3 years just haven't really tried to think about what that implies for the next several years. If the economy was this resilient and could grow with the Fed raising interest rates from 0 to 5.25%, 5.5%, shouldn't we incorporate that into our thinking of how it will deal with other shocks? Like right now, we've got all this people call it chaos, turmoil, uncertainty about what this administration is doing, particularly with regards to tariffs. And yet here, the stock market's holding up pretty well. And any sell-off related to the tariffs has actually turned out to be a buying opportunity. Now, people have made the correct point that if you look below the surface, there's been a lot of churning around. Some areas that might be affected by tariffs have gotten hit. Meanwhile, other areas have done relatively well. But I'm assuming that the Magnificent Seven are going to stay magnificent for a while longer. I don't think they're about to disappear. They're doing a little churning of their own right now. I'm assuming that the S&P 493, that their valuation multiple could go up from about 19 to 20, 21. I believe that what drives valuation multiples isn't just interest rates or inflation. It's not a reversion to the mean model. Just because the PE is 20 and the norm has been 15 doesn't inevitably mean that today, tomorrow, or a week from now, or a month from now, or a year from now, it has to come down to that 15. I believe that a lot of the valuation issue relates to how long do you think this expansion is going to last? And the longer you think it's going to last, and the more optimistic you get about earnings, assuming that's rational, not irrational expectations based on technology, the technological impact on productivity, then I think the reasonable assumption is, yeah, these valuations are high, but if I buy it here, the earnings growth in a few years will bring it back down to earth, at least relative to where I bought it. How much time do I have left? Okay, then let me just, so that's, I give the roaring 2020s a 55% probability. So you would say, well, all that for just 55%? Well, 20% is for the 1990s, which is kind of the roaring 1990s, but it ended with a melt-up, and then that was followed by a meltdown. That could happen again, given that where valuations are. If they keep going up, I think the 1990s would be a model. But it doesn't have to be that it will be followed by a long bear market in technology. A lot of technology back then was literally hype. This time around, I don't think that's the case. And then 20% that it's the 1970s, that's the bucket where we throw everything that could possibly go wrong. So for a while, we thought it was geopolitical risk, 1970s, two energy crises, war, Russia, Ukraine, a war in the Middle East. That could certainly lead to higher spike in oil prices, but that seems to have simmered down for now. Another possibility, Ray Dalio goes around worrying a lot. I don't know what it is about these billionaires that they are so pessimistic. Give the rest of us a chance. But he's warning that we're in an imminent debt crisis. It's a relevant concern. We'll see how the Doge boys do in Doge City, Washington, D.C. There's probably a gunfight between the Doge boys and the Democratic attorney generals, and the bond vigilantes may stir up some problems. But at least this administration knows that they have to do something about it. Certainly the Treasury, the Secretary, has said that he's aware that the focus should be on the long end of the yield curve, the bond market, and not beat up on the Fed. And then inflation could come roaring back, I suppose. But again, we're betting on productivity being a very powerful force in keeping inflation down. And finally, of course, what's new with this administration is tariffs. The 1920s ended badly with this Wood-Hawley tariff. This administration has called it not retaliatory tariffs, but reciprocal tariffs. I hope what they mean by that is that if you charge us 20%, we'll charge you 20%. We'll impose them in 30 days. That gives us 30 days to talk them down. So I think at the end of the day, these tariffs will actually go down rather than go up. Obviously, a controversial issue. Let me close by saying that I want to leave you with two thoughts. One is, isn't it really amazing how well the U.S. economy has done despite Washington? Think about that. I think that explains why the stock market has done so well over the years. It's because working stiffs like us have made this economy what it is. It's us that, the presidents say we created all these jobs. I got my own little company. I've hired a few people. Maybe some of you have done the same. If they just leave us alone, we'll do fine. And if they don't leave us alone, we'll figure out how to get around it, how to deal with it, and we've done an amazing job of that. And then I'd like to leave you with the idea that the thought that not everything has to go wrong. There's so much pessimism out there, and think about the possibility that things might actually go right. And I think that's actually been fairly descriptive of the history of the United States for quite some time. And finally, it's okay to be a permeable. And I'll tell you why that's the case. It's because the stock market is a permeable. Thank you. Yeah, okay, fine.
Could we get your quick thoughts on China? I know you expressed some pessimism about that.
Sure. China is the world's largest nursing home operated by Maoists. It's hard for me to get excited about investing in a country like that. And they changed their mind right now. They owe a lot of their success to the Communist Party realizing that their model wasn't going to create prosperity. And they actually let capitalism into their country for 20, 30 years. And it worked like a charm. There were entrepreneurs making a lot of money. Standard of living went up dramatically. They built it wasn't all capitalism. The state did build a lot of state-of-the-art infrastructure, but to do that, they had to hire capitalists who knew how to design and do things right. So it worked very well, but the capitalists were getting so rich and powerful that the government decided, this is too much power. So around 2012, 2013, President Xi started to tighten up on the capitalism in China, and the economy started to falter. It got hit by the pandemic, of course, but it really never came back solidly out of the pandemic. And meanwhile, they're also paying the price for the one-child policy, which was another brilliant move by the Chinese Communist Party. But now, all of a sudden, they're trying to make nice again to business people, to entrepreneurs. They're very proud of DeepSeek and trying to get more entrepreneurs to create more growth in their economy. They realize that their export model isn't going to work the way it had been, especially with this administration. So the markets had a nice rally for sure, but I can't get excited about it on a long-term basis. I'd rather overweight the U.S. Look, you're very kind to ask me about Argentina. You make it sound like I know a lot of things, but I don't really follow it other than the way all of us are following it in the press, and it looks as though the new president has been very, very successful with his tough love approach to the economy. And it's really amazing how quickly you can turn an economy around once you change the rules and make them a little bit more entrepreneurial. So Argentina's fine. I've got no problems with the course they're on now. Sure.
So I think similar to the Industrial Revolution, where we're at with the technology revolution is good for consumers and businesses, productivity. But unlike the Industrial Revolution now, where AI is headed, it might not do so great for jobs for the middle class. AI might be able to pull back jobs, but increase productivity for businesses. Do you have any thoughts on that?
I didn't get everything quite right, but you're basically asking whether the digital revolution, the AI revolution, is going to have some losers in the middle class.
Correct.
Suddenly they're not middle class anymore. Is that what
Correct.
you said? Yeah. Look, I think it's a reasonable concern, but people do rise to the challenge. They do see how things are changing, and that they have to respond to those changes. But look, I really don't view AI or any of the digital revolution as a real threat to jobs. We've got a real shortage of skilled workers in this country. And I think what AI and other digital technologies are already doing is augmenting the productivity of workers, particularly the productivity of the brain, the ability to process a lot of information and come to conclusions with it. I guess this year or next year, Tesla and a lot of Chinese competitors are going to be starting to sell humanoids that can be used in manufacturing. At some point, they can be brought into the house, I guess. I mean, it is kind of creepy that all this stuff that we watched as kids that was called science fiction is now becoming science nonfiction. Elon Musk, one of his favorite books is A Hitchhiker's Guide to the Galaxy. He was very much into science fiction, and he said, hey, I can do that. And so far, he's managed to do some of that. I think it'll really be, I don't know whether it's going to be science fiction that Elon can do what he's done in Twitter and other places in terms of cutting costs in the government. But I'm open-minded to the possibility that they'll save us a lot of money, and that will be a big relief, but we'll see how that goes. But no, I think the middle class will continue to do well, and I think the kids of the middle class, they're spending all this time kind of immersed in the digital revolution. I think they're kind of be naturals at it. So no, I don't worry about that too much. Maybe I should.
Dr. Yardeni, what impact do you think that free open source software will have on the productivity gains between now and the end of the decade?
Well, again, I showed you that productivity chart, and we did see a low in productivity growth in 2015, around 0.5% at an annual rate, which is pretty pathetic because the arithmetic of GDP is really very simple. It's the growth rate of the labor force and the growth rate of productivity. So we know the labor force growth, especially now, is relatively slow at 1%. Maybe for the past few years it was somewhat higher, and the statistics have been revised to reflect more immigrants. But demographically speaking, and now with immigration policy, we're probably going to see the labor force grow by no more than 1%. And when productivity was growing only 0.5, that only gives you 1.5 real GDP growth, which is pretty pathetic. But more recently, it's been growing around 2%. And so that gives us 3% growth, 2.5 to 3%. And if we can take that up by a percentage point, that all goes into real GDP. So I'm looking for productivity growth of 3 to 4%, up from the average of 2%. Okay, thank you.